Procurement to payment is a key process in any organization. That too for a manufacturing company, the efficiency of the procurement to payment process will determine its profitability. Let us understand some of the key steps that are involved in the procurement to pay process. It's also called as a P2P process. Step 1 would be the raw material requirement. Step 2, the purchase requisition approval. Then step 3, supplier selection and PO creation. 4 being goods receipt and quality inspection. 5 being invoice verification. And then 6 payment processing. And then 7 periodic reconciliation. The objective of this video is to give an overview of all these 7 steps that are involved and what typically happens in an organization. Let us go to step 1. Step 1, raw material requirement identification. The key step in a P2P process is to identify what is the material that is required to be purchased. Now, for the material to be purchased, the obvious first step would be to identify what would be my sale. Sale of the finished goods would determine what raw material that I would need. The quantity of the FG material determines the quantity of the raw material. So, the first step would be the sales forecast generation. Generally, the sales and marketing team, based on the historical data and trends, market demand, they predict the future sales. It could be the business plan, it could be sales plan, it would be 3 months, 6 months, 9 months, 12 months, or year 1, year 2, year 3. Depending on the type of organization, type of the manufacturing activity, the sales forecast would change. The objective of the sales forecast is to give a fair estimate of how much is the expected sales. The second step would be to determine what raw materials would be required to satisfy the sale. And this is done through a system. It is generally called as the material requirement planning MRP system, which in most of the companies are automated. This MRP system would basically pull in the FG quantity that is to be produced, that is to be manufactured, and the bill of material, also called as the BOM, is configured in this MRP, which is basically used to arrive at the raw material that is required to be purchased. And depending on the lead time and also the percentage of vendors to whom the order is to be given, which is basically the ratios, the order will be triggered. Now, the input for this particular raw material requirement identification is the sales forecast, and the output is basically the MRP system, which will identify the raw material that are required to be purchased. Now, this is step 1. Let us see step 2. Once the raw material is identified, the MRP system in most of the cases prepare something known as the purchase requisition, or it's called as a requisition or a purchase request. Generally, system driven purchase requisition or purchase request is auto approved because the logic is defined in the system. But it is possible that there are manual purchase requisitions that are raised for various purposes. It could be a non-production item like consumables, or it could be raw materials which are not covered by the MRP system. There could be various reasons why a PR or a purchase requisition needs to be approved. Now, after it is approved, if the value is higher than a previously defined threshold, it goes for a subsequent approval depending on the value of the purchase requisition. This would ensure that the purchase requisition that is created is in fact approved, meaning the requirement is approved for the next step. The next step here is supplier selection and PO creation. In this step, first, the approved PR, the purchase requisition which is approved, is sent to the procurement team. Generally, the status basically goes to PR is approved. Now the procurement team will be able to view these PRs and then be able to create a purchase order out of it. So the approved PR is sent to the procurement team. If this material is already being purchased by the organization, then they can go with the existing vendor, else they will float RFQ, which is request for quotation, to multiple vendors. They will receive the responses and the vendor will be selected based on the company's policy. It could be selection based on L1, it could be selection based on quality rating, it could be selection based on terms that is agreed with. Every organization has its own purchase policy. So you would have to look at that to confirm that the vendor has been selected based on those policies. Once the vendor has been selected, the PO is created in the system. And this PO will basically undergo a lot of approvals based on value. It will basically go through a lot of approvals. Now, there is a committee generally which oversees this vendor selection, which is called as a purchase committee. Purchase committee generally comprise of the CFO, purchase manager, quality manager, production in charge. So all the heads of these four departments, sometimes HR is also involved in case it's a subcontracting activity. Else these four key departments, which is headed by a managing director or a president of an organization, decides on what is the on who is the vendor for a particular material. Once the supplier is selected, the PO is sent or a purchase order is sent to the supplier. With this, we conclude the third step. The fourth step is goods receipt and quality inspection. Once the PO has been sent to the supplier will basically manufacture the products. The supplier will basically manufacture the products, and based on the PO terms, based on the purchase order terms, the material will either be supplied to the company or the company will go and pick up the materials from suppliers. It is also called as the milk run, where the company would basically obtain or will arrange transport to pick up the materials. You can see this lot in the automotive sector. Once the goods are delivered, a preliminary check is done by the warehouse team. Remember, this is not the final check. The warehouse team will basically check if the quantity is what has been delivered as per the invoice, or if there is any mismatch. Now, before it comes to the warehouse team, the security will basically look whether the goods have been sent against a purchase order, whether the goods has various regulatory requirements like GST, e-way bill, invoices, any statutory documents required. Third, the security will basically check if the quantity are packed right, etc. But they will not get into a lot of details. The warehouse team will check whether the quantity is making sense, whether the quantity is accurate. And then comes the quality inspection team. The quality control team will, based on the technical parameters of the material, will perform a quality check. And this ensures that the material that is received is according to the specification which the company has ordered for. Then comes the GRN creation. Once the quality is cleared, a GRN is created. In some organizations, like which runs an SAP environment, the GRN is created before the quality inspection, but it is not moved to something called as a free stock. It is held up, and only once the quality confirms that the material is as per the requirements, the quantity is added to the free stock. Once the GRN is created, then it goes to the next step. It is possible that there are some rejections that are coming out from the quality inspection. Now, rejections are of two kinds. One is the GRN rejection, which we see now. There can be another type of rejection which are called as inline rejections. Now, these rejections are manufacturing rejections which come out during the manufacturing process. we will probably cover that in subsequent videos. But the rejection that we are talking now is at the time of GRN. Now this concludes the GRN step. The next step is the invoice verification and three-way match. When we say three-way match, what are those documents that we are referring to? We are referring to the purchase order, invoice, GRN. Purchase order, GRN, invoice. These three documents have to match for both quantity and price. It is possible that against one purchase order, there are multiple GRNs, and against one GRN, there can be multiple invoices. But my invoice quantity cannot be more than the GRN quantity, and the GRN quantity cannot be more than the purchase order quantity. This is a check. Generally, there is a system check that is there. If there is no system check, then we will have to check whether this validation is available. Now, once the three-way match is performed, there could be some discrepancies, prices are not matching, or some of the PO terms like taxes are not updated, and those discrepancies are basically discussed, coordinated, and sorted out. So this is the invoice verification process. The sixth step that we are going to see is payment processing. Once the invoice verification is done for accuracy and compliance, the invoice is sent for approval. Generally, someone in the finance department will basically approve the invoice, or it is auto accounted based on the volume and the nature of the invoice. And the organization will basically run something called as a payment processing. They'll basically process all the open invoices. When I say open invoices, there could be some invoices which are not yet due. Based on the purchase order terms, there could be some invoices which are not yet due. Based on those which are due, the system will automatically take, or there can be a manual system which will basically identify the open purchase orders for which payment is to be processed. Now the payment processing can happen host to host, which is right from the ERP to the bank. With a click of a button, the payment will automatically be transferred, or the details can be downloaded and an offline bank advice can be sent to the banker. There are various methodologies in which the payment processing happens. We will look at the risks and controls separately. Payment method can be either direct transfer, electronic fund transfer, check. And once this payment is done, the accounting entries are passed. This is our sixth step, which is payment processing. And coming to our last step, which is periodic review and supplier performance evaluation, which is step 7. Supplier performance is evaluated by various methods. One is the delivery timelines, quality, pricing, and continuous improvement initiatives. At the end of the day, we need to check whether the supplier is giving us the best quantity at the best price at the best possible timelines. There is also a supplier reconciliation, meaning accounts reconciliation, that needs to be performed to identify if there are any anomalies. With this, we have covered the key steps in the procurement to payment process specific to a manufacturing industry.